Hi, everyone, and welcome back to another episode of Unlocking Venture Capital. I'm here with my good friend Jeremy Kagan of Textbook
Hi.
VC. Hi, Jeremy. How's it going?
Very well, thank you.
So, Jeremy is not only a fund manager, but he also is a teacher at Columbia and has done a lot of great work with the university student body. And so, would love to kind of dive into, where he sees things are going, and would love to learn a little bit about your fund. Tell us about Textbook, Jeremy.
Well, Textbook Ventures is a dad joke because I'm a professor at Columbia, Cornell, and NYU. I
Hmm.
think it's hysterical, and they just get worse from here. But in all seriousness, the name reflects the fact that we are doing things by tapping into the ecosystems of these schools. A lot
Yes.
of my former students actually have started companies. Some of them are actually successes and have been the LPs that supported the fund in the first place. So successful entrepreneurs from my past funded the fund saying, do the same thing you did when you advised and helped me, but with these new companies. And this is really tapping into the mentoring and network I've built here in the city by just being around for so long. I'm very
Yeah.
involved in the startup world. I had a startup myself. Then I ran the Lang Center for Entrepreneurship at Columbia Business School. And when I left there, it was with the purpose of becoming, not part of the school proper, so that I can actually invest ethically in the startups there.
Right. So tell us a little bit about that. So you get to be part of these great ecosystems with multiple schools. You've done this for several decades, seeing these students grow and develop, and really adapting to the new technological advances that are coming up, right? And so when you got to want to then be their investor, how does that work? And what are the kind of rules and jurisdictions for people who are interested in this kind of space and wanting to invest in more students?
Well, it's challenging because when you're at a school, the reasons you're investing are somewhat different than as a professional investor, and as a new fund manager in particular, I'm very very picky. So for starters, when you're running the center at the school, you're trying to encourage more entrepreneurship, develop ideas in interesting areas, sometimes in more social impact areas, invest in more diverse founders, and all those things that are very clear goals that a school can really work with. As a investor on the other side, where we're focused much more on making returns for our LPs, it's a lot about the math simply means that you have to swing for bigger exits.
Mhm.
So a lot of what people don't realize is when you're investing, not only do you have a very small and it's a small pool of capital that you guard jealously, but the investments you make are not just weighed against the company itself, which may be a great idea, maybe a fantastic founder, but your other options and the potential outcome. So if we think it's a fantastic idea, but it's going to be a small company or a service company where it's not going to really have true venture scale and margins, we just can't do it. So I think that's where there's is a challenge. On the other hand, things like AI and SaaS, where we know the drill, we can add a lot of value, helping with marketing strategy and things like that. It can be a very good fit.
Yeah, no, absolutely. And what kind of trends do you think that you're seeing over the past couple of decades that you've been a professor and seeing what entrepreneurship is like and how it's affecting your students and how they're kind of coming out with these new ideas? Because I know that when I was graduating, you had very limited choices of what you were going to be doing, right?
Yeah.
And then if you chose entrepreneurship, you had to do like 5 minutes of explaining why to whoever you're talking to. But what would you say has evolved over the time that you've been involved with these students and the university while being in venture?
Well, I actually literally have been teaching for 20 years, and so
Yeah.
clearly I started when I was 4 years old. But the difference is when I started teaching digital marketing, it was a really crazy new thing, and now it's
Right.
like the main way you get your first customers.
Right.
Most of the startups back then, you were the strange black sheep, especially in a business school. Why aren't
Yes.
you going to banking or a big company? And
Hmm.
now it's a little bit more of an accepted career path. People going to Google's and Facebook's, etc. Those are giant companies now. There's like a path there for an MBA career. The main difference for entrepreneurs is that the tools are so much better now that the
Okay.
differentiator isn't can you figure out how to build a website? It's if you want to do an e-commerce store, Shopify exists. So it's
Yeah.
much more about coming up with a new idea. And even with AI and all these amazing insights in climate and things we look at, it's less, I think, about the capability of people to actually create the technology or the website or application or anything. It's really more whether the idea makes sense to the customer, which is a little bit more of a pure focus. So it's not if you build it with it, will they come, field of dream style. It's really much more about does the business model and the value to the customer make sense to the point where they're willing to pay for it? And
Yeah.
the irony right now about AI is nobody cares about AI. Customers don't care if it's AI or magic leprechauns. They just want to know, are you solving my problem? And they're willing to
Absolutely.
pay for that.
Yeah, and it does take a lot of risk and a lot of gumption to go out there and pound that pavement, you know. One of the most fun and challenging business cases that I had to do was because I lived in Canada, right? To sell ice cream in January at a corner. So
Yeah.
we had to do that in teams of four, and to see who would make the most revenue, you come up with your own business strategy. And that was so intense and scary and also very cold for us. Do you think that today's students are more risk adverse, or they have a bigger appetite risk when it comes to building businesses and pounding that pavement?
I think there's a wider spectrum of people getting into entrepreneurship in the first place. So the bar was way higher back then, where you had to be really willing to make no money and eat ramen noodles for years.
Right, the
You
ramen
can
profit.
actually, yeah. And now you can even go, you can quickly go to an accelerator, get grants. There's a lot more programs to support you, so you can at least make a little bit. Plus, I think there's a lot more acceptance of entrepreneurship as a career. Since a lot of entrepreneurs, it doesn't work out, I think companies now know more where to plug you in, so you can actually go and get a job. Whereas, in the early 2000s, if you were the CEO of a company, people just thought you were crashing on your mom's couch. They didn't really know what that meant and how the struggle was. Now people appreciate how hard it is to build your own thing, even if it doesn't go very far. The learning curve there, it's almost like we always joke around. It's like dog years. It's like 7 years of experience for every year you work as an entrepreneur because
Yeah.
you're doing so much and you're working a lot.
I love that comparison because I try to explain it to people who are first-time entrepreneurs, and a lot of things are happening to them all at the same time,
Yep,
and they can't figure out like why that is. And it's true. It is like dog years. You're absolutely right. And I really love that. I'm going to steal that from you.
please do. And these days, there's somebody smarter who said, "Look, there's only really two roles in an early stage startup. You're either building the product or selling the product.
Yeah.
And if you can't figure out where you fit in, then you don't really belong there at that point."
Right.
So we invest at the stage before, right when that's actually a real question. And I
Right.
think that this flipping point, if I had to pick a weird one, between early stage and growth stage, which is, late stage venture capital can be much more in around financial results and stuff.
Mhm.
That's the sort of funny but almost true thing is that a company's later stage when they start to have an HR person.
Right.
The
No,
minute there's
that's
somebody
absolutely
there,
right.
yeah.
And I think that, when there are fewer people with more roles, you have a lot less ability to hide. Your skills are your skills, and you can't really fake anything else for long term. It's not sustainable. But when you're in a very large environment with lots of muddiness, you can fake that for a whole career's worth, and nobody would ever notice. And
Yeah,
so I
people
think that
do.
it definitely does have a bar somewhere else for sure.
Yeah, there's definitely, in a startup, there's more of an ability to, there's a much more tolerance for failure because nobody knows what the heck's going to work or even what to do. But there's no
Yes.
tolerance for faking
Yeah.
because if you're like sitting around, doing whatever the equivalent is of jiggling your mouse, at a big company, because they're sitting next to you and they're going to come back and say, I built that product you asked for. Where's the customer you said you were going to get? And or vice versa. We see a lot of that. The biggest problem with startups is doing a lot of work in the wrong place.
Yeah.
People like to look busy and keep busy. You have such limited resources. You got to really work smarter because otherwise, if it was just a labor problem, Google or Facebook would throw a bunch of engineers on it.
No, absolutely. Absolutely. And like when you first raised your fund and did your first investment and you're like, this is the one that I'm choosing, what would you say to the Jeremy back then? Like what would you have done differently in your first few deals you would say that you've learned from today?
Um, we've done about 12 announced deals and I probably have three in the pipeline. And
Mhm.
I don't think we would do anything different. I think I'm seasoned enough at this point that the only things that matter at the very early stage are the founders and the market.
Mhm.
Now, there's one company that didn't work out, and the founders had a fight. The co-founders had a fight.
Uh,
That was one of the problems. They were good guys, but ultimately, if the tech guy decides, well, I want to do something else, and I don't really want to work on this anymore, it's very hard to save a company at the early stage, in that way. But there
yes.
wasn't anything, we do a review of anything that doesn't work and say, is there anything we could have known? Were there any things that were warning signs? And there really
Yeah.
aren't anything. The
Yeah.
truth is, this is a business where most stuff doesn't work. All we can do is try to help as much as possible, and we can volunteer help. We can't go in and do the job. So I find it always surprising when, I offer to give someone the benefit of my point of view. I may be wrong, but I've got years and decades of experience, so at least listen to what I have to say, and they don't even follow up. So that's a bad sign. I don't expect people to do what I tell them. I expect people to at least consult the free, knowledge that you have on your cap table to get a sense of it. But I don't
Yeah.
think we did anything wrong. I think we're still focusing. The only thing that proved to be wrong for us, honestly, there is one thing. We originally, when we designed the fund, the idea is we would put $250,000 to work, and the ideal idea was that this is half of a friends and family round. So we're in early, we cover half of it and bring in the other half of people. The
That's a
reality is some
that's
of
a
the
good
hot
strategy.
deals.
Sorry?
Thank you. Sorry, please go on.
I would say that's a good strategy, but how did you come up with this is the number, this is the vision, and how did you sell that to your family and friends when you gathered this as well?
Well, let me put a bookmark in that for just a second, because the
Okay.
flip side of it is we realized that in some of the hotter deals, we can't even deploy that much capital. And since we don't have a ton of capital, it made more sense to do 50 or $100,000 checks and get into a good deal rather than being really strict about that. So we
Okay.
changed one thing, which is that we write checks of as small as 50 to be involved. Uh,
Mm,
So that was the only real difference that we see. But what we what we found is that part of the reason people investing here, if, as an emerging manager, the very first investors are people who know you and trust you, just like a startup, because I have no track record. They've got some things like the things I invested in the Lang Center and my angel investments, my syndicate investments, but fundamentally, they're betting on you. The second batch of investors, we're in our second close. Those people look at the initial investments and say, hey, this strategy is actually getting them into some great deals. And then I imagine the final close will be greedy people who see that we're already making markups. So they're going to be like, I'm basically able to get into a deal that's already doing great.
that's smart. Yeah. No, that makes a lot of sense. And I think that that is not just an investment, it is also in life where they're kind of seeing like, how much should I invest in this human? And that makes, yeah, exactly. And I think that that's really like a psychological reaction to things because to, you always want to be on the right side of rooting for the right people to succeed. You know what I mean?
Well, you always hear the VCs say that, well, we're a value-added VC, we try to help, and so many of them it just comes down to forwarding TechCrunch articles. I don't want to be that guy. I want to stay out of the way unless I actually have a valuable introduction. You know what I mean?
Yes, yes. So there are people who I'm sure hundreds or millions of students by now have actually like asked you the same thing where they're like, will you be my mentor? And I'm like, am I the right person to answer this specific thing? Am I an expert in the thing that you actually need? Or should I be helping you find someone who would be able to be more of value, you know? And so having that was I felt to be like a lot. And so you're absolutely right. Bringing value is a broad way of saying that you're more than a check for sure to an investment, any investment deal. But how you're bringing it is really important, and knowing when to step back is also really important. Do you have an example of when you're like, this is a good time for me to step back, or I'm going to go find someone else that would be a better resource for this particular scenario?
Well, we're early stage, so one of the best things we can do is help them design their marketing strategy, refine their strategy of like go to market and pricing and things like a lot of the digital marketing stuff that I do. But part of being value add can also be founder therapy, like was what I call it. It's sort of like executive coaching in a way, but less professional and more about sympathy. Because
Mhm.
when you're a founder, if one or two guys in a room, there's bad days and good days, and sometimes the same day is that day. And sometimes I get texts and calls all the time. What we need to do is give them perspective for the long haul. And one of the best ways you can be helpful is just to introduce people to customers.
Yes.
People want the resources to build, so they want money. But if you've already invested, that's going to be the next round. So can we introduce them to follow-on investors? And we do that. And the more of a track record of success we have, the more those people are going to respond more quickly to the call. I have people who complain about not getting deals suddenly start responding to my emails more. And that's good. That's the way it should be. They see that the proof is in the pudding.
Yeah.
The second thing, though, is can you get me customers? Because what gets you to that next milestone these days, and especially in New York, where we're much more practical, is show me some people are paying for it. Because otherwise it's just an idea.
Yeah.
And so if we can bring in a few customers, some friendlies to talk to you, tell you what they, even in the beginning when you're just trying to figure out how to sell it. So I'm connecting two guys, one of my first investments and a guy who is a senior data guy at a big Fortune 500 company. And he's going to talk to him about how to pitch people like him. That's going to be valuable.
Yeah.
That's the kind of value add because I happen to know the guys and they can meet in an informal way. Secretly, I want to see if you can get this guy to join him in the startup. So I'm trying to inception that a little bit, but one thing at a time. Let's get them to meet and see if they have good chemistry.
That is great. Oh, I love that. And for your fund thesis, do you have a certain kind of target for those that are going to be student entrepreneurs versus those who are like in your program and things like that versus those outside? Do you have a specific kind of target for the breakdown in terms of how you're seeing your community?
Honestly, it's not really about student entrepreneurs at all. It's usually the best investments are the ones that are the second or third company from a guy I did know as a student, and they did a good job with their first company, but maybe didn't knock it out of the park,
Hmm.
or maybe it didn't work out. So I've got several investments like that, and usually those guys, I gave them advice the first time, and they want to have me on speed dial for whatever the relevant term is now, first one. So that's been great. It's gotten us into deals maybe that we wouldn't have otherwise gotten into. Because when you're writing small checks, we know we're not going to be taking the whole round and being able to follow on like that. What they want is that strategic connections. And so we can get them into places they couldn't get into. We have relationships with various schools and
Yeah.
organizations to make those connections.
Well, if I had any questions about schools, you're definitely on my speed dial. You're the only one I know who would know the answer.
The schools have great ecosystems, but it's important to remember when you're on the outside that they're not always focused on the same things. They're focused on commercializing research and teaching researchers how to be entrepreneurs. I don't necessarily think that's the way to do it. What we want is ideas that are going to be good businesses. We have a portfolio strategy, of course, and while we're not really specific in a vertical or anything, there's a lot of stuff we won't do. We won't do anything that has, FDA approvals or other regulatory approvals
Yeah.
because if they say, oh, well, we're going to reject this, but if you come back in 2 years, like we can't last 2 years. We can't give them
Yeah.
that cap.
Absolutely. It's
Tough.
so risky to give your capital to something that you can't get a refund for, like FDA approval, because it
Yeah.
does take a lot of time and it does take capital and it does take a lot of investment to be able to do that. But I believe as of now, they do have funding and grants to help you with some of those fees. That has nothing to do with being investor ready just yet.
Yeah, we work hard to find like non-dilutive stuff like the NSIN program from the federal government.
Yeah.
There's companies we have that have gotten lots of grants from the government to build prototypes and things like that. But the reality is the most important thing is getting some customers. If you can get some customers and get to, you know, default alive break even where you can survive, then you are going to do much better than someone who's like, well, we need to go raise more money and hasn't accomplished anything.
Hmm.
We have examples of both, but I think people don't really understand. Like the minute we invest, we're saying like, get customers, get customers, get customers. Here's some introductions. And if you don't follow up on that, then there's very little we can do.
Yes.
We can only
Yeah.
open the doors. We can't push you through it.
Have you ever had the scenario, just kind of focusing back on what you said before, which was so interesting, that some of the hotter deals are you have to be more flexible to get into, right?
Oh,
And
totally.
so, yeah, and that's something that I think first or even sometimes second time entrepreneurs, they don't realize that. They're just like, when I build it, they will come. And so, and they don't all show up the same way too, especially emerging fund managers don't all show up the same way. And so, was there a scenario where you really wanted to work with this entrepreneur? They wanted to work with you too. They think that you guys, you'd be able to introduce them to customers, great partnerships, help them with a lot of advisory. But there were differences in terms of what's expected in the round dynamics. And then how did you kind of manage that? What happened and what did you thought was such a like a positive outcome from this?
I can give you a couple examples, but we really don't encounter any challenges like that. We've turned down deals where everything looked good, but the valuation was too high. A couple Y Combinator guys, you
Right,
know, they,
right. Us
they've
too.
done a great job of having double the valuation they should for a small raise, and I think that's just unfortunate. We can't afford to overpay because then the outcomes become tougher.
Hmm.
And more importantly, as an early stage manager, I'm very acutely aware that this is a relay race. And it's a very hard one right now because the guys I have to hand the baton to, not all of them are actually investing. They're taking care of their existing portfolio. So we really feel that you got to get to the point where you can survive long enough for the current frozen sort of Series A, Series C landscape to sort of thaw a little bit. And I think it's thawing. It's just, if you're in a relay race and there's nobody to give that baton to, you die and you lose your money. So we're
Yeah.
very acutely aware of that. Um, an example, it's almost a feast or famine for these poor guys. So we have a company that was referred to us that I'm meeting with this afternoon. They are completely oversubscribed and not taking any capital, but they're
Why
willing
are
to.
you meeting?
Well, because they're willing to take a check from us because we write small checks. We don't have ownership targets because we're too small. And we have a couple of great connections that we have a good track record of making introductions. So they're considering taking just a little bit more from us. And actually, the fact that we're willing to write small checks is a virtue for them right now because they don't want any more money. They
Yeah.
want a strategic investor.
Yes.
They don't need the capital. So I'm going to talk to them. It may not work out. We've had people like that who took the money because they wanted to be able to talk to us and to be able to get our connections. And that's kind of what you're supposed to be doing anyway. So,
Yeah, no, absolutely. And I think that that's such an interesting way to do that and to then have a smaller check because it's already an oversubscribed round. There's nothing really you can do right now anyway because like what are you going to do? So that's really great. And I think that's a really good lesson as well to have being like there are still other ways around it. And I know that there's lots of creative ways that especially emerging fund managers have had the ability to do in the past that have been incredible moonshots. So I wish you the best of luck with this upcoming meeting. I hope it will be
thank
a great
you.
moonshot.
Yeah, it's a little bit off the beaten path for us. It's a really cool device in sort of, I'll just say generally, it's a really massive improvement of efficiency in the built environment space that people are seeing a payback in just a couple of years. So they're really very promising. Like utilities want to incentivize their customers to buy this stuff. So
Yes.
let's see if we go there. But um, I can talk about some of the stuff that is public that I'm proud of. We've got a couple of companies like Jericho Security,
Okay.
which is a former student, second or third company. His co-founder took his last company public. So these guys could just say whatever they wanted for valuation, and we said yes. But somebody else worked with them to set that, and we got in early enough, and now they've just signed the first ever. They're a cybersecurity company defending against generative AI attacks, and they just signed the first ever generative AI contract with the Department of Defense, $2 million for the Air Force. It was just announced. So we are very happy about that. So that's good for us. Um,
Yes.
got another company. There's an array, but I mean, we've got companies, a lot of companies in AI, but in different verticals. Because of my digital marketing background, we're pretty comfortable in the marketing technology space. So we've invested in Branch Lab, which does cookieless IDs for connected television advertising in the pharma and healthcare space. And they were being having some great successes. I think they're going to go out for a big round as well. We've got guys doing AI for media bidding and programmatic who are crushing it. They're already doing six figures in revenue per month. And had a triple oversubscribed bridge round just to support all their paid pilots, which was at a markup for us. So we're very happy. Um, a bunch of other stuff that's real meaningful too. We have a couple of climate investments that could have a big impact on things, and just generally happy with being able to see such great stuff coming our way. Really
Yeah. That's
amazing
amazing.
deals. Yeah, it's really
And
good.
congratulations on being able to find those winners. It must mean that you have such an array because they're so different that you have such an array of deal flow kind of coming in too. So I know that, for those of you who don't know, Jeremy and I met at a Founder Institute event where, again, there was a lot of great, interesting deal flow at the pre-seed stage because they were from all different sectors. And we were panelists for that event. It was a lot of fun. And so what are your other, I would say, favorite sources in terms of deal flow that you would like to share that you're involved in actively? So then people can also join in and participate and get to meet you as well.
Well, I think that the challenge is like most people think of deal flow as like demo days and stuff like that. But the truth is, you got to be involved earlier on to start identifying the people you might be interested in.
Hmm.
I would say it's almost like by demo day, if you haven't picked out the companies you already like, might be too late for the best companies. But the things that it's not rocket science, it's about putting in the time and the energy. I'll take the coffee meeting with a former student who's got an idea. And more often than not, I'm giving them constructive criticism and advice. It's not going to be for me. But you have to meet with a lot of those folks over and over and give them good feedback because otherwise the meeting isn't valuable. Met with a student yesterday, a great guy, but I didn't like the business, and I gave him some ideas of what the problems were for me. So at least the meeting wasn't a waste for him. He has some feedback, even if he may think I'm wrong, and I hope he's incredibly successful and proves me wrong. But I think the basic blocking and tackling that I've done for 20 years is taking the meeting. Student wants to have a coffee or do a Zoom or grab a beer. I met with a guy who's in between looking for his next startup yesterday, and we had a great conversation, nothing specific, but when he does find something, he'll call me and ask. And I've done that for years. Founder Institute, ERA, all the accelerators that I'm involved with, the mentoring, the office hours, the presentations on how to kick off digital marketing. You have to give to get in this business because that's how people come back to you. They know that you don't have, your hand out, you're waiting for shares. I have a bad memory of somebody from my own school who wouldn't make some introductions until I gave them advisory shares. And I was really disappointed because, I was a student and that was part of their job. But they saw some green at the end of the tunnel, I guess. And I've never forgotten that. I was so angry.
Yeah. And
Um,
learning from that, you're providing a different kind of mentorship to your students. And
yep.
I was just going to say that, based on that, you said you gotta get in early, you gotta meet them early. I'm like, you meet them when they're 18, when they come to your class. You can't get earlier than that, Jeremy. So you're
Now,
very
honestly,
lucky
we
to
meet
be in
them
that
before they
position.
have an idea. Like the one of the companies we're looking at tomorrow, the guy was he raised a couple $1 million to do a different idea and realized that this other thing was better. And
Wow.
I didn't like the last idea. I really like this one. So he
Okay.
spent and his pitch is like, yeah, somebody else paid for me to figure out what to do, and now you can invest in the new company. I'm like,
So
that's my
he used
favorite way of doing it.
used his money to do a pivot and then raised another round and be like, now I will call Jeremy. That's
Yeah,
amazing.
well, I'm grateful because like I he called me first and I said I don't like this business. I didn't think it was for me, but this one is more unique and interesting, and it's still it's still very risky. But I think the thing is if you are involved, if you're there as somebody to be a sounding board
Yeah.
when it's not like we're ready to raise money, that's the reason they're going to call you when it is time because
Yeah.
you want to be a trusted advisor, somebody they can count on. And that means I do a lot of meetings that go nowhere for no, like, as my wife said, the whole point of venture capital is now I might get paid for the stuff I do for free anyway. And so for me, that's great. If I can start going to all the countless things I do attend and go to and try to help with, and now there's a light, a way for me to participate in the upside, it's
I
good.
mean, I know there is. You cause so many ripple effects for people. And I think that, maybe you don't even know it, but you have definitely caused ripple effects for me in my career and the guidance that
Thank
you've
you.
given me in the New York ecosystem. And I'm super grateful for that. So I know for a fact that all your former students have benefited well from being in your presence.
I'm really grateful to that. And honestly, it's funny because the people you have done a small favor for, but it was meaningful for them years ago, they're the ones who have a friend who has a really hot new company and they need to know somebody in New York and they call me and I'm like, whoa,
You
I
are
got
Mr. New
to
York.
know
That is
you.
true. You are actually born and raised and you know everything about it. So that you are real New York.
Yeah, I can look out the window and literally I can see Astor Place that way. That's where Facebook has an office, and so on and so forth. I'm smack in the middle of it. I also think that's part of it. Like as an emerging guy, I can pop out for a beer at the
Yeah.
drop of a hat, whereas I know a lot of VCs who say they're based in New York, but they're not here every day.
No.
And to me, that's like if you're not here every day, when you do come in, you meet the people you already know. You don't meet new people, you know.
That's true. That's very true. Because it is harder. It's like a comfort zone thing if you're not there every day, or if you just live in a neighboring state and you just write that you're there.
Well,
Which is completely
there
different.
are people who get on the train or the bus and they come in regularly, and then there's people who don't. But
Exactly.
I always make fun of those guys because like they're like, well, how do you get the deal flow? I'm like, I'm here. I'm here listening. I'm talking to people. And that's what it takes. It's a numbers game in many ways. It's about being trusted, and my hope is that it's the better folks that come to you first after a while. That's how brand name VCs do well. But I know that I'm an emerging guy and it's my job to go out there and put in the time and the effort. I've been doing it for 2 decades now. At least there's an opportunity to benefit from it.
Absolutely. And I can see the benefits now. So I hope that your startups do really, really well. I'm sure that your portfolio companies are really happy. And I also just want to thank you so much for your friendship to me and your time for joining me today.
Well,
Um,
my pleasure. We got to get you in a good role so that you can be a catalyst for new entrepreneurs. And I'll just
right?
say, if anybody's listening and they are interested in the New York accelerator ecosystem, if you go to textbook.vc, which is our website, you can get a free copy of this PDF we put together of every New York accelerator. We did all the research, so you don't have to. And it's just so we can know who you are.
Yes, we will plug that in as well. Thank you so much, Jeremy. And thank you, everyone, for joining us on another episode of Unlocking Venture Capital.
Thanks so much.